Yo, what's going on, you guys? It's your boy Jerry Trades back in another breaking video, and on today's video I want to go ahead and jump into something that I think as early investors, early traders, you guys should get the hang of, and it's navigating all-time high markets. Never before has this video been more important, because now we're trading at historical levels in the S&P 500. Companies like AMD, companies like Amazon and Google breaking new records, new all-time highs, outperforming. And as an investor, I think it's very important you just gather another opinion on how to perceive them and understand, hey, usually during these events, there is a lot of catalysts, there's a lot of components that you want to be paying attention to, but is it really where you want to buy at? And that's a very, very difficult question to ask for some of these companies. And many people can oftentimes, find themselves buying at highs. A lot of emotions come when you see levels and movement like this. A lot of people, have this Fomo, fear of missing out. It's this emotion that we as traders use as a term to describe an investor's, like when people see money going a lot, remember GameStop and AMC? Like when people see that there's a lot of money flowing to one asset and it's just getting more and more out there, more and more recognition, boom, they flock to it. Same thing like Dogecoin, same thing like Shiba. These very highly marketed, low barrier to entry opportunities that portrayed riches. And oftentimes those went down to zero. But that's not what's happening here in the S&P 500. These are real assets. These are real companies that are building the future, that are building the foundation for the next generation. And you're not necessarily buying something like a high-risk asset like that. And I share this to clarify that between the stock market and a lot of these cryptocurrencies, a lot of these meme coins that now younger generations are being exposed to, these aren't necessarily the real hard assets. Maybe crypto later down the line, but as of now, stocks are always going to have a very, you can say, sustainable value, because they're built on companies that all of us use: Microsoft, Google, Meta, Tesla, Coinbase, AMD, Nvidia, big companies that they're not going nowhere. So you can look at this as an asset to protect your money for the long term. But now, back to all-time highs. Is this a point where you want to be buying, or is it a point where you want to be selling? And how should you be viewing the market right now? Share the information, bro, because I know how hard it is to find it. So just to have someone to relate to, someone to kind of digest this and explain it to you, I always want to be able to do that for other people just to help. So let's go ahead and dive into this screen recording here. So as you guys can tell here, I have some of the biggest components in the S&P 500 on my right, and then I have the S&P 500 on my left. And for those of you guys that are brand new, the S&P 500, like I said, it's one big portfolio with all the household names in them. Tesla, Amazon, Microsoft, Google, Nvidia, Broadcom, AMD, Coinbase, Berkshire Hathaway, and so many more are in the S&P 500. So the S&P 500 tracks the biggest performing companies, so a lot of investors use this as a trend to know where the market could be heading. But when it's at all-time highs, it's kind of difficult to tell where it's heading. So let's go ahead and bring SPY up to the full screen. I'll go ahead and erase all my annotations here. And I want you guys to just look at this. Let's turn off my extended day trading. This should help. So when you have a picture like this, and it's just continuously going high, a lot of investors are fearing that, hey, I could have bought here and made this much. I could have bought here and this much. This happened just early last month, about no more than 36 days. Boom, immediately rallied from 630 up to 733. A whole $100 in the S&P 500 in less than almost 60 days is historical. That's an immense performance by the markets, and this all stemmed from, let's go ahead and jump now into the context, the Iran and Israel ceasefire that was announced early April. Now, just I believe this week on Monday, we received that Donald Trump has officially somewhat ended the war and went into sharing on his Trump social. I'll go ahead and share the post right here for you guys to check it out. That the war is now over and investors are just loving it. But just on Monday, they shot cruise missiles. So Once again, we're seeing the Trump manipulation with the not so story adding up. Just on Monday, we did have 4 cruise missiles shot at Iranian Navy attack ships, I believe. Here's the article right there. So, hey, we're all kind of going up because of this war, but more importantly, another sector of the market I believe all you guys should know about is these semiconductors and chip manufacturers. There's an insane demand to continue producing the technology that we all use to communicate, that we all use to connect with one each other, like on our computers, on our TVs, on a lot of devices out here. An immense demand. Technology is only more advancing and people are becoming more and more dependent on it to be able to create more opportunities. So the demand is at an all-time threshold, and we're only able to meet necessarily this much supply. So let's say we have 100% of demand, we're only capable of meeting 20% of supply. So investors are weighing in that these companies are going to be able to amp up their infrastructure to meet enough demand, technically having now an infinite money business model because there's just endless demand. There really is no way that this is going to end.
A few short months after GTC DC, 1 year after last GTC, right here where I stand, I see through 2027 at least $1 trillion. Now, does it make any sense? And that's what I'm going to spend the rest of the time talking about. In fact, we are going to be short. I am certain computing demand will be much higher than that. And there's a reason for that. So the first thing is, we did a lot of work in the last year. Of course, as you know, 2025 was NVIDIA's year of inference. We wanted to make sure that not only were we good at training and post-training, that we were incredibly good at every single phase of AI, so that the investments that were made, investments made in our infrastructure, could scale out for as long as they would like to use it. And the useful life of NVIDIA's infrastructure would be long, and therefore the cost would be incredibly low. The longer you could use it, the lower the cost. There's no question in my mind. NVIDIA systems are the lowest cost infrastructure you could get for AI infrastructure in the world. And so the first part was, last year was all about.
So the fact that we're here this early, okay, it's something to add, right? Different component. Whoa, this in the next 30 years could be something, and I do agree. But how do I want to navigate this as a short-term investor? Maybe the difference between 733 and 7, maybe 10 is a big decision for me why I don't purchase. You know, the gap is just too much. Now you're waiting for some sort of a come down, a pullback, right? So as an investor, my advice, my perspective on it is, yes, in the next 30 years it can be something. Yes, it's a safe investment. What I mean by more than just S&P 500, to be more specific, hey, a lot of these companies right here are technically, you know, you have Micron Technology, SanDisk involved with some of these infinite demand sectors. You have AMD, an infinite demand sector. You have NVIDIA, infinite demand sector. Broadcom, infinite demand sector. You have Amazon now making their own chips. Google making their own chips, both in infinite demand sectors. You have Tesla, I think it's Terafab. Boom, right there. Now to make its own chips. Infinite demand. All of tech is now flowing to chips. And this is a rotation. Software. Some money from software is now rotating into chips. You have Microsoft being a software. Let me bring up Meta over here for you guys. Also pushing down lower. Look at this. Previously trading at 677, now at 612. Prior to that, trading at 734, now trading at 612. There's a lot of room for these money in software to now transfer to somewhere else. And that's what it's doing. And everyone's betting on chips right now. But will in the next 4 months, 5 months, it be at these levels? Will demand still necessarily be this high? How are these companies going to navigate losing investors? Because you have to remember, as shares get higher, they lose less investors that are now more retail. People that are more established are buying shares at 1,000 a pop and buying, what, 200 of them at a time? You're talking about easily, bro. Let's do some mathematics just to show the screen right here. 1,300 times 200 shares. bro, you're paying $260,000 on just one investment. Now, there's people out there that are doing that, and that's why SanDisk has this type of volatility. There's people paying at these prices, and they're not just buying 200, but they're buying a lot. So there's a lot of money in this boom, in this sector. And I honestly do believe that with the future, in the next 30 years, hell yeah, it's going to be worth a lot more. But for the time being, I think this is a very overvalued market. I believe that with this promotion and propaganda of this geopolitical conflict coming to an end, this is slightly overvalued with it not being confirmed. And until it's confirmed, maybe my bias will change, but I still believe that this market, everyone should always have a little bit of a side note when approaching all-time high markets, you know? Amazon, history, bro. Just the other day, right here, May 5th, 278, highest it's ever been in history, to my knowledge. Just confirm that. Right here. Yep, 278.5. All-time high history, May 2026. Beautiful. Congratulations, Jeff Bezos. Amazing job. Over here, you had Google. Did Google go for the 400s today? Yep. It looks like she wanted 399. I'm pretty sure she pennied that 400. But easy, Google. Now, never before seen history was made today. Congratulations to Google. And this is a performance all around that we've never seen. But is this essentially where I want to pivot myself to buy? And now I'm saying these opportunities are very good for the long term, but in the short term, understand that it's slightly overvalued and there's more of a pullback, a profit taking that all of you guys should be aware of during these all-time highs. There's always an investor that was buying in, let's say, the 2000s, buying in the 1990s, that is now approaching retirement, now approaching what they've worked for, what they put their money to the side for so long for. And they just don't want nothing to do with it. They're ready to just live their life. They're ready to just catch a break and just enjoy it, see what it's really about, you know? Every day those sellers are coming out. And these individuals have a lot of value in the market because they've built so much equity. Now, these individuals that are cashing in right here, eventually, we're retail, you know, we're the brand new generation always trying to put money in. We got to always be conscious of the generation that's taking money out. And that's where we want to be. Now, okay, let's see. And never ever do you want to be purchasing at all-time highs. Let's see if we pull back down. Let's see if there's some sort of, at least a cheaper deal, whether it be 5% off, 10% off, 15% off. That's a better approach than now I'm buying at the top expecting a plus 10%. Perhaps it can happen, but at all-time highs, it's always a little bit more riskier. Allow the asset to find some sort of, you know, I guess you can say fair value, where buyers and sellers are meeting. What can this look like on the screen? And when you look at here, let's go ahead and jump to the day chart, clear out all annotations, and let's zoom in on these candles here. You see how there's this gap? Now, it's not always defined or expressed as a gap, but how you would want to see, how I view these things are, here's our support, right? Support's always going to be these levels where you see price bounce up from. So here we had a clear jump from here, 298, another one here, another one here, and another one here. So that's our support, right? And we had a resistance up here at the top. Looks like she struggled to break here. I want to say roughly, it's only one, so we'll want to lower that maybe to like 336. And then she broke out. But there's still, how I view these things now, is like this is, let's say the 0% of the move. Okay, now we're at 100% of the move. What do I believe it could draw down? And I'm never ever unrealistic with how much this could come down. You never want to be like, oh, it can come down to the bottom, now 80 percentile. I highly doubt this type of purchase is going to draw down 80%. But let's look at it S&P style. You know, the S&P style to catch you guys up is every year, supposedly, the S&P has done 10% APY for the most part. Sometimes it does 13, sometimes it does 16, but 10% APY is kind of the bare minimum expected. So if you're able to do this in, let's say, 2 months, you're outperforming the S&P 100 by still 10 months, allowing you to maybe outperform it with more trades, more investments. So when you're allowing a 10%, 20% retracement, you're purchasing this asset, trying to outcompete the S&P 500 by at least a break even of 10%. So don't purchase at these highs expecting higher. Me, when I set myself up, I look at the move from the bottom from when it started, 273 to now 398. So 398, hey, what can 10% of that be? Well, let's go ahead and look it up. You know, you have 398. That's going to be minus 3980. I'm just going to round that up to 40, like it's 20 cents. So let's go ahead and look 398 minus 40. And that's 358. So right here, we'll go ahead and mark this out. 358 is right here. Perfect. At 358, literally where that gap is at. That's your 20% retracement. That's where you should be looking to purchase Google for the long term. Because now you allowed yourself that 20%. And now, how much Google should I buy? Well, this is specific to Google. Every position is going to look slightly different. And this is why I tell you guys, as not a rule to thumb, a one size fits all, but if you can go ahead and save 20% on any asset that you're looking to acquire for the long term after conducting your research and getting to know very in depth what their financials are like, what their price to earnings is, what their forward guidance is, what their financials, I guess you can say, on their earnings came out to. Man, it's multiple components of a company, their partnerships, what are they, man, you could dive deep into fundamental analysis. But when you begin to view into your companies, go in depth, and then, hey, if I could somehow acquire this for minus 20%, just allocate your capital on the side. And when you do, don't go ahead and put your house or anything on the line, Just go ahead and allocate I can say easy, maybe 20%, of your buying power, something minimal to introduce yourself to the position. If you have these high shares, right, for many, these are going to be your first shares that you're buying. Bro, if you could buy a, $400 asset at 20% off for $380, bro, you're going to be doing phenomenal. Phenomenal right there. That's 10% off. Now, if you do 20% off, that would be your whole entire... Now, if you're somehow able, you got to view it as you have to view it through this lens as well. I think it's very important that you view it through this lens. If you're able to acquire the asset for somewhat cheaper, buying for the next 30 years, it really won't matter what lower it goes than that. And so, when view and I think it's and jumping into how important this is. So Google is going to be a unique example here, right? But I don't want this to be a one-size-fits-all example for you guys. I want you guys to be able to view and understand that, hey, right here, when Google is at the 400, let's say round it up, right? Let's say Google's at 400. If I can acquire this asset for 20% off in the short term, maybe in the next 2 to 3 months, buying for my long term would be now more insured of a 20% gain because the potential high has already been achieved. Similar to why I'm investing in Tesla at 398. Tesla at 398, let's go ahead and look at the bigger picture. Now, this is why I tell you guys, not all, it's not a one-size-fits-all scenario. Tesla over here is trading at 500 a share, now at 398. That's way below our all-time highs. But now I know to expect in the next 30 years that potential from Tesla. So am I afraid of buying Tesla right now at 396? Absolutely not. Now, this is how you use previous all-time highs as a point of reference. Now, this is why I tell you guys, purchasing at all-time highs can be potentially very risky, because if you were the guy purchasing Tesla at 495, look at how below you are because you were purchasing at these all-time highs. And they happen quite often. AMD is one example. Look at yesterday, AMD made history, jumped over almost 6%, 10% overnight. Opened up at a high of 430. Look at what happens when these companies reach all-time highs. 430 all the way down to 402. Lost $28 in share value in a single day. Not even a single day, actually. Look, 644 to 721. Almost 38 minutes, 40 minutes. Lost over $28 in share value. Put options would have killed that right there. But just to highlight to you guys now, people buying at the top, it's much more difficult, much harder for them to make a profit. And you have to be able to view it through that lens and be careful when deploying your capital. Be smart when picking your purchase times. And if you have a difficult understanding of how to go about purchasing, look at my investment timing video. I go into looking at just market structure and understanding when it is you want to be purchasing versus when it is you're looking to maybe hold off on the reels a little bit, And I share this with you guys because the selling part, it's a whole different conversation that we'd have to jump into together on our next video. But go ahead and check out my market timing video and you'll be able to now further understand when it is you should be buying. The selling part, we'll jump into what to expect, what I kind of view as my selling target on the next video. But I hope you guys enjoyed this one. Leave a like and subscribe. Jerry Trades the SoCal Trading Group. Glad to be able to help all you guys. I hope this video, gives you the time, the attention, kind of the patience that you need to be able to just view this through a different lens and not be the guy that's just purchasing at these all-time highs with the fear of missing out. And this has happened for countless assets, not just companies. Look at silver. When silver had its big rally, people were going crazy buying gold at 5,600. Look at what happened. Reached all-time highs, 108, and then boom. Absolutely tanked down to 70, low 61, $60. Blew out the water. And that's what I'm talking about. All-time highs are never the time to be purchasing. If you're not a part of the train, it's okay. Conserve some of your capital on the side. And now, when it does come down, you know what to expect for the future. But make sure that these assets are credible. Don't be holding the bag, which is a term referred to individuals that just don't know when to take their losses. If you have an asset that dropped, let me go ahead and point this example out to you. It's very important that I got onto this train of thought here before we wrap things up. Sorry to kind of do that right there, but it came to my mind and I want to be able to provide the most clarification as possible. So look at this company called Enphase Energy. I love this energy company, but very scary. They used to be trading at 337 a share, now only trading at less than 90% of that, 35 a share. Do I want to buy this company expecting it to go to 339 because I know that's the upside potential of it? Maybe, but also maybe this company doesn't have what it used to, and now it's struggling to get back up, and many investors are stuck. they are never going to get their money back from what they purchased up here. And that's what we call to look at holding the bag. So if you do have losers, right, treat them differently than your winners. Know when to cut your losses and reposition the remaining capital you have to maybe buying at a cheaper price or just buying another asset. This Enphase Energy is an example of a non-credible asset. The fact that you don't know about them is enough. You have to be paying attention to the household names: Tesla, Amazon, Microsoft, Google,